Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad that you could join us. We do this live show to try to help people improve their retirement, and we do that by answering questions. So you can send in your questions now, and we try to answer them live. Send them to the Ask Tom at talkmoneywithtom.com, or you can put them into the chat, and we'll try to do it. You can send these questions during the week, too, if you want us to have a little time to work on them. And we often cover questions that come up during the client, meetings too. So a lot of times these are things a lot of people might want to know. And obviously we've created this channel. You can subscribe to the channel. You can, look at the content here. There's over 1,500 videos on here now. And hit the little bell button if you want to get notified when we put new content out. And you could just meet with us if you want, just some personal questions, or you want to have us discuss something. We do a free 30-minute appointment with whoever would like. We have a book appointment button on our website. Website link is right here on this channel. You go up in the corner, see a button looks just like that, and set up a 30-minute time to meet with Ethan and I on the phone, a video, come into the office, whatever works for you. So that's our starting of our show today. Very excited about it. I do like to start off every show with a summary of kind of what we saw happening in the market this week. And so this week, unfortunately, has been a tough one. This has been, down every single day this week.
Yeah.
Luckily, it's only a 4-day week. It's been kind of interesting just in the sense of, this softness that is kind of expected in September. Sometimes, people are just kind of gearing up for that. And we'll take a look at kind of what's going on. This chart here is kind of the longer term chart. This is weekly data. You can see, the trend is still intact. That's for sure. And we've had a nice run since October 13th of 2022. Lots of hiccups in there. Lots of, downturns that have happened, yet we're still marching along as far as that goes. And so, we'll watch and see. I'm going to move in a little bit closer here. So this is daily data just for about the last year as far as that goes. And so you can see what happened in August. We had 8.5% drop from high to low, and then we recovered that whole thing by the end of August, which was kind of incredible. And the peak that we're still trying to get back to was done on the 16th of July, 5,667 on the S&P, and the S&P is now at 5,400 and change. So we're not that far off. You can see we're falling again. We didn't set up a new all-time high, so you kind of get this little double topping effect that's happening here. So that's somewhat of a concern as far as that goes. I've shown here in this particular slide, there's the last low, which was set back in August, and part of the primary trend directive is that you want to keep setting higher lows. So if we set a lower low than that August piece, then we are now, one check mark closer to establishing a downtrend. One of the other check marks, though, that can be quite important is the, it's not showing. Look at, that's not moving. It's moving on the screen here. It's not moving there. Oh, how do we do that?
Can you pause it?
We'll be right back in just a second. Got to fix technical thing.
Okay. You can go back to 2.
All right, we're back. Thank you for waiting. Sometimes technology is spectacular, and sometimes it freezes up on us. This is actually a pretty complex set, and sometimes the pieces work better than others. But nonetheless, the second piece that you really want to see is the relationship between the 50-day and the 200-day moving average. So If you look to 50 days, that's, orange or yellow golden line, and then the blue line is the 200-day moving average. And when those cross over, that is a definitive signal of primary direction change.
Yeah, that's a death cross.
Yeah, the death cross. So they call it the golden cross when it passes up through. We had that in February of last year. That worked out exactly right. The market's been running very nicely. We had a death cross back in 2022. I think it was in March or April, and that turned out to be fairly accurate also as the market continued to fall the way till October. So, but the first checkbox for me is always that higher lows. So it'd be nice if we hold up above that, but it's not the end of the world. This particular market environment, we've had such a good run up this year. And actually, if you look at this is the last 12 months. That's a pretty big run up altogether.
Yeah, and you can see the spread between the 50 and the 200.
Yeah, that shows you the power, right? The more spread you have, and it also shows you kind of the stretched nature to a certain degree of the market, because the farther those get apart, they'll revert back down, and that's kind of what's happening now. They're getting a little closer together, and they'll probably continue to do so. But still, primary trend is up. However, as this chart shows here, on September 3rd, the hourly primary trend changed back to, down, as it did back in July. And so again, for us, that's just sort of a minor early warning signal. No big downturn can start without the hourly chart showing the downturn. But really, we use it for new money coming in. We'll usually wait once that turns negative and just kind of sit on the sidelines and try to, see where the market's going. We don't want to, buy a falling knife or try to catch a falling knife, right? As far as that goes. And then our bigger weekly data, market breadth pieces from all these, either very well diversified or targeted, economically sensitive areas, utilities, transportation, semiconductors, et cetera. Everything is still green. That's going to be a slower one that just sort of confirms, how far down we are and where things are going as far as that goes. But right at the moment, things are okay as far as that goes too. So we'll see. Again, this is not meant to be an early warning indicator other than maybe that hourly portion as far as that goes. So it's sort of a confirmation of what's going on. So, here's what I find very fascinating. So over the last 8 weeks, this is what we've been buying, right? Real estate, healthcare, financials, consumer staples. And there's an ETF that is called USA, actually, minimum volatility factor from iShares. And what we've been selling is all the technology pieces that we have.
The high standard deviation.
So we still have a majority of our money in the S&P 500 type things or the Vanguard Total Market type things. I mean, the broad pieces. But what we have are these targets. And so we have 181 ETFs that we've culled, onto our universe list. And what we're doing is we have a methodology to kind of see when things are moving. And what is basically happening is it's really where the money's going, right? Or at least staying. Because if it's leaving technology, the technology is going to slide down that list and it's going to push the other things up, as far as that goes. And if you look at today, all of these are doing better than the market. And so the market has been moving, and we haven't seen this type of rotation. The reason we had all technology for quite a while, really, since maybe the middle of last year at least, had mostly technology-related pieces in our targets, and now we don't have any. So the market has been preparing for this particular volatility time frame or soft time frame, and you can see what's going on. They're moving into these other areas, and there's lots of different reasons that would happen. Most of these areas are considered, not all, but most are considered defensive. Consumer staples, healthcare is the reason staples in healthcare, you always need toilet paper and food, those type of things.
You always need to go to the doctor.
And you always need to go to the doctor. Maybe not for the minor things that happen, if things are really bad, but for the major things, healthcare still goes. So, financials can do well here theoretically with a lowering rate environment might help, as far as that goes. So anyway, I find this very fascinating. I think it's really important to understand that there's a rotation going on right now away from technology. These are the areas that we're seeing. And we're buying these not because of some grand economic model that sees what's coming. We're just looking at the market and looking at where the money's going and what is moving, right? And so if you just watch the momentum, you can catch some of those waves and move into those areas. And it also, I think, is instructive. If you watch that universe and if you look at what's happening, you can kind of tell. I mean, when technology's running and some of the higher beta things like NVIDIA are running, right, there's more confidence in the market. When these types of things are running, the confidence is drying up.
Yeah,
right?
it's a risk off event.
Right. Now, this might not be very long. Who knows? I still think, once the election happens, we're back to a risk on event, so
Yeah,
to speak.
it could just last till the rate cuts,
Yes.
or, September, mid-September.
Right, exactly. So, but I present it because I find it very fascinating. I always, you can really kind of see what's going on if you watch this ETF universe that we have, and you see kind of what's moving up and what's moving up and what's moving up. And so far, this is what's happening. So I think that's interesting. We don't have all of these in every model. This is just, one segment of our, model portfolios, but it is the one that's maybe the most interesting. So that's why I talk about it. Now, this is the CME Fed Watch tool. I know it's a little hard to see, but there's some important points here, and I'll use this to kind of describe what's happened today. So today's job report came out. 165,000 jobs were expected. Ended up with 142,000 jobs.
So not too far off.
No, and actually, I think we were at 144,000 jobs last month, so kind of the same. Still growth, right? But just not as expected. However, unemployment actually dropped from 4.3% to 4.2%, and wage growth was at 3.8%, which was higher than expected. Those two things are quasi-inflationary, or maybe a different way to look at that. The Fed, with higher wages and lower unemployment, the Fed is going to want to do less rate cuts.
Yeah.
Right? Now, when they get less jobs than expected, maybe that counters that a little, but if you look at this chart, we're at 73% for a quarter point and 27% for a half a point rate cut. Yesterday, it was at 40%, right? For the double rate cut, for the half a point rate cut. And so what's happened is the market is very specifically telling you that this jobs report is not recessionary. It is potentially inflationary, and it looks like the Fed will have some room to just do a quarter point cut based on this data.
Yeah, because I know there's rumors, just some articles I read that people were fearing, a 5-digit job growth. And so, only, sub 100,000.
Yeah.
And they were fearing that there'd be a major fallout from that.
Yes, exactly. I think it came out in a decent spot, but the market's down a bunch today. Yeah. And so part of that reason is because there was probably an oversized expectation for a half a point rate cut. And so the market kind of starts to factor that in. And now we're back down to a quarter point rate cut, and the market kind of takes some of that money back, right? I mean, it's kind of a silly little game that goes on, combined with the fact that this is a seasonal issue too, right? The time of the year. And so that's what I'll present here. So this comes from Market Watch. This is the last, however many elections going back to 1952. This is the rate of return for 2 months, so basically 60 days before the election. They got the Dow, the S&P, and the NASDAQ, and the NASDAQ didn't start until the 70s, so you can see that. And a couple of things that strike me, okay, if you look at the last, 5 elections, 8, 12, 16, and 20, they're all negative. Every index, some more than others, sometimes are worse than others. 08 was, we're right in the middle of that big downturn happening, that kind of, but they're all red. Matter of fact, in general, there's more red than green across the board.
Yeah.
So you're looking at a situation where the market does really well in November and December after an election, right, on average, and doesn't do that well before an election. We've been talking about this since the beginning, right? As a matter of fact, in the last show, we were hitting, kind of a really close to the all-time high. The Friday last show, the market was up like 1%.
Yeah.
And we were talking about how I just didn't see this scenario where we could just run all the way through the election and hit new highs and new highs. I said, I just couldn't see it, and this is why, because of this. This is a lot of my experience fits into this time frame here from 2008 and beyond for these presidential elections. It tends to be soft. 2020, what the 2.9% down for the Dow, 2.5% down for S&P, 2.6 for the NASDAQ, right? Pretty consistent across the board. So anyway, that's something to consider here. So you have this scenario, right, where earnings are good.
Yeah.
They're solid. I mean, they really are. You got the employment picture is at least mixed, not as crazy as it was, but mixed isn't bad in this environment because it really is contributing to the soft landing scenario that we're still in, by the way, which is kind of incredible. And then the other thing I'll share here, I got this from the Fool, Motley Fool, and this shows the rate of return for the market, okay, for the last 11 rate cuts. So from the day that they do the rate cut to 1 year later, is the market up or down? In this case, the S&P 500, 12 months later. So if you look closely here, there's 11 spots. 9 of them were higher, so 82%. So if you had a coin that you could flip 11 times and you knew it was going to come up heads 9 times out of 11, you'd bet on heads, right? I mean, just from a probability standpoint. And so here we are. It's kind of interesting. We've got this election time period, which has been showing a lot of softness in September and October prior to elections since 2008. And then you've got a rate cut that's going to come very likely on the 18th of September. And the market does quite well over the next 12 months. If you line those two up, you're looking at a possible buying situation, right?
Yeah.
I mean, there's not enough evidence to show we're going to go sliding off into some big recession. We're getting mixed numbers, which really is what you should be getting if you're in a soft landing. Those mixed numbers could turn more negative, that's for sure, or more positive for that matter, because we do get some good numbers that have come through here. The gross domestic product was revised up to 3% for the second quarter. Consumer spending has still been pretty decent, On the other hand, factories are slowing down, so this is part of this kind of slowing back down to some form of normal. And I would assume travel is going to come back down to some normal level, with people kind of getting that out of their system. They couldn't travel for a while, those type of things. So I think this is a very fascinating market. I believe that the, downturns that we're having, this week and those types of things are okay. This is what needs to happen for this market to kind of get ready for that next big leg up. And again, 9 out of 10 times after a rate cut, the S&P 500, 9 out of 11, the S&P 500 has had an increase of an average of 14% across that range. And so, there's the positive side. And we got all kinds of little cross currents going on right now. But I think it's still a really healthy move that the market's making. I have no problem with small downturns whatsoever. I know, I'd rather it just go straight up, but honestly, when that happens, then you end up with big downturns. And so I'd rather have the steam come off, these 5-10% deals that happen, even 15%, whatever. It's all part of the norm as far as that goes. We don't need these 20 to 40 to 57% downturns. We really want to avoid those. And so that's what I think the steam coming off allows. The overpricing can get so stretched out to the upside sometimes that that's when you really are at risk, more at risk. Everybody's celebrating because we're making great money, but for me, I start to get really nervous. That's when I get nervous. These little downturns, I'm actually get a little bit more comfortable in this time frame because I look at the dynamics, the earnings, the rate cut that's coming, and it's a good thing to let some of this steam out. That's my opinion. We'll see how this plays out, but nonetheless, that's a summary of the market this week. I appreciate everybody joining us. This is a big week, lots of things happening, so wanted to make sure we covered it as well as we could. Look forward to looking at this 2 weeks from now. Next week, I won't be doing a summary. We won't be doing a show. I'll be out of town. But a couple weeks from now, we'll do this again. Great. What's our first question?
So we talked about this last week, but what expires at the end of 2025 with the Tax Cuts and Jobs Act?
Yeah, that's pretty interesting because this is not being talked about that much in the election process here.
That's true.
And it's kind of a big deal. If you look, 2017, we put together, these new tax tables and new tax cuts. We've got a kind of a comparison here we can show you for, what's going to expire, so to speak. They call it sunsetting. And so we're going to go from a 37% top bracket to back to, in theory, if they don't do anything, to a 39.6. Okay. There's a pass-through for income deductions that you're allowed up to 20% right now. That's not used. We don't have any of our clients using that.
It's more for business owners.
Right.
It's self-employed people.
Right. that the child tax credit will drop back down to $1,000. That can be a big deal, right? That's important because that's a credit, so it's kind of nice. And then the standard deduction, and this is actually maybe a really interesting piece. So it goes from 24,000 married filing joint back down to 13 again, for example, and single filers go from 12 back down to 6,500. When they moved up from 13 to 24, it was incredible. I think it was something in the neighborhood of 40% less people needed to itemize. It was pretty high. Matter of fact, it dropped it down to the number of people needed to itemize to a pretty small amount as far as that goes. And so that will be interesting if they drop that back down because then you're different strategies maybe for charitable giving, different things along those lines.
Yeah, and one of those deductions that itemized deductions that kind of fell out of favor was the SALT one, which is state and local income tax or taxes essentially. And so the deduction was capped at $10,000, but that deduction is the limits on that deduction are going away. So for higher tax states like California, where you can have high income tax, that is really beneficial.
Yeah, we used to be able to write off whatever you paid, for the property tax, for example, and whatever you paid for state taxes, which was, can be a big write-off depending on your income level and where you're at. And let's say it was 75,000 you used to be able to write off if you added everything up, and it got capped back down to 10. And so that was kind of punitive after the higher tax states and what have you. So that expiring, that's actually a really good thing.
Yeah.
However, the tax tables are changing, the standard deductions are changing. So there's some increases to go with that, offset of decrease. And so there's some other charts here kind of interesting. This a little hard to see all this, and there's another graphic I have after this, but it just shows kind of the brackets and the projected bracket if they let it expire, right? And so it's projected because there is some increase that happens
with just inflation,
right? With inflationary, and whether who knows what Congress is actually going to do, right? But in theory, they might want to go down that path if they are going to let them sunset here, and maybe everything stays the same, but if you look closely, what you can see is basically, for the most part, you're going to end up with a bit higher tax here. Maybe there's some offsets with the SALT piece going away and what have you too.
Yeah, it also depends on where you fall. If you fall in the 32 or 35% brackets, your brackets are kind of getting smaller, but you'd have kind of a similar tax rate.
Yeah, and this is a pretty cool chart here. This shows the blue line is where we are now, right, in terms of the tax rate. And income levels, right? The orange line is if they sunsetted it back to the projected, levels. And so if you're single and you make between 200 and 500,000 by chance, you'll actually pay less tax under the
post-tax.
Revised back to sunsetted levels. You'll pay more if you're under 200,000 and more, and that's orange, part of that chart, and more if you're, above that 500,000, might be 550 or what have you. But so that's kind of fascinating. On a joint filing tax basis, which is the next chart over here, you're going to pay more, at least from the table standpoint, almost all the way across.
Yeah, but this is not going into like there's a lot more deductions that were kind of limited with the Tax Cuts and Jobs Act. And so a lot of them are coming back. So one example is mortgage interest deductions. So with the Tax Cut and Jobs Act, it was limited to 750,000. So that's reverting back to $1 million. So you can take interest off of $1 million now.
So if you can increase your mortgage interest deduction, you can increase your write-off for your property tax and increase the write-off for your state taxes. So this chart's kind of showing the gross, taxable, taxes go up. Your net taxes after those deductions, it depends on your deductions.
Yeah, one thing that's not really shown in these charts is because these are all kind of like tax rates for your, gross income, is the changing of the state tax laws. So state taxes were essentially doubled, or like how much you had a tax credit for, and with they'll expire. And so right now it's at $13.61 million per person, but it's going to expire and revert down to $5 million that's inflated. So people are projecting about $6.4 million of tax credit per person.
Yeah, and that's kind of significant because, if you had 13 million per person, that's what, 26, 27
Yeah,
million,
yeah,
dollars that you could pass to your heirs without any tax. If they sunset that, we go back to, and this is a projection, because it was at 5 something like you said, and the projection is 6.4. So now you've got maybe 12.8 million that you can pass. Again, for a lot of people out there, that covers it.
yeah. It covers the vast majority of the
But if you happen
population.
to have like a 15 or 20 million dollar estate, you just went from being covered to being exposed.
Yeah,
So it'll matter to somebody, believe me. And so that, but that's actually a big piece too. And so all of these things they could do doesn't all have to sunset. They could keep some, they could sunset some, they could change some. I think this is going to revolve around a whole tax, scenario, corporate tax, individual tax. We're going to get probably another 2017 type debate going on about what should happen with the taxes. And then the Congress makeup will be a huge deal here. Is it all one party or not, right? Does it all line up with the White House or not? Or is it a bifurcated Congress? Because that could make a huge difference too as
yeah.
to what actually
I could
happens.
see a bifurcated Congress, nothing being done and kind of just letting it
Yeah,
go.
then you get the sunset because nobody can agree on, what else to do. There's no negotiated ground. So taxes are kind of weird. I often have seen, I think, a bit more on the negotiation side on the tax thing, but yeah, we'll see. That's not been true for this particular Congress, that's for sure. All right, so what do we have for
Um,
our next question?
what are your thoughts on rare earth metals?
Rare earth metals. Okay, so rare earth metals are metals that are used, the important ones anyway. They're used in technology
Yeah, so
products, lithium for batteries, right? I mean,
lithium, cobalt, uranium may possibly be in there too.
yes.
And so kind of like these specialized metals that are, you know, are tough to to mine.
Yeah, the majority of rare earth metals are under Chinese companies' control worldwide. And so to the neighborhood of 80 plus percent of world. So it's an interesting area because they've got a bit of a crossover there. You have China's stock market is struggling, right?
Hmm.
And so you have these companies that have control of these assets that are important to the world, but they're on the Chinese stock market. So if you look at, I've got a chart here of one of the ETFs that does. Maybe one of the only ones, VanEck Rare Earth, and Strategic Metals ETF, REMX. So this is the lifetime return chart for this. It came out in 2010,
Yeah.
right? It's down 38% this year. Yeah. I think it starts off at a $10,000 investment, turns into 2,000 something now. So it's been terrible as a long-term hold,
But there's
no
been
doubt.
periods where it's been tradable.
Oh, definitely. So this, for me, if you're going to ask me a question about this, I don't know that I'm looking at this for a large portion of my portfolio just because the volatility is so high. Something small percentage wise, and I'm not sure I'm playing this as a long-term hold either. It hasn't demonstrated that ability to me at this point in time.
Yeah,
It's more of
because
a tradable asset.
the thing is with these companies, you can always create more production in theory. So there's
Right.
always going to be more production coming online.
Yeah, and so if you're asking me right now, and it's down 38% year to date, I'm going to have to assume you're kind of a value player,
Hmm.
right? And so if I'm a value player, and I'm also going to assume if it was me, this is a trade, not a buy and hold, right?
Yeah,
Which is not my norm, but I would look at two buy points, right? Two different scenarios. First one is the one that's right above my head. That's the kind of the low point that this ETF has hit in the past. So I might have a buy down in that neighborhood and just wait and see if it comes to me.
yeah. It bottomed out kind of around that area twice, and it's
Right.
popped up. So
Right.
maybe it's another like spot that you can buy again.
Yeah. Again, from a trading standpoint, if it got back down to there, I'd probably take it if this is something I was interested in. The other thing I'd look at as a momentum investor, which is mainly what I am, is I like to see that primary downtrend break that we're in right now.
Mhm.
And the first category of that break would be to set a higher high. You can see every single one of these highs is lower,
Mhm.
right, than the one before. So I drew a little line up there. That would be another place that I would put in a buy, is if it started to move because it can move. I mean, this run that it had in 2020, it was up 400 or 500%. It was crazy. I mean, a really big move. So from a trading standpoint, you could play that. We don't do this. It's too volatile, from that standpoint.
Yeah, it depends on your style of investor. For my
Mhm.
example, I like to have a story behind my investments, and so I try and see, what's the story behind it. And when I think rare earth and strategic metals, I think, technology and EVs particularly. And so for me, I have a hard time seeing it as like a long term play. But
Mhm.
if you're saying like for maybe I get in, I hold it for 6 months to a year,
Right,
take my profits and head out,
right.
yeah, that makes total sense.
Yeah, no, that's a good question. It's a very important area. It's very interesting. I would assume you'd have a huge pop in this area if China had any type of real issues, politically or geopolitically, dealing with Taiwan, because they have such a high control of these. If they start to cut back production just as to make the West suffer or what have you,
Yeah.
that could drive price here, and these could come up in that regard. So it's a hedge against that type of geopolitical, issue as far as that goes. But again, like he says, the story isn't great, right? I mean, again, I don't need a story if I'm just going to trade it. I need a
Hmm.
story if I want to buy it long term. Like we were talking about Intel,
Yeah.
right? And so Intel's been hammered. I mean, down
Yeah.
46% the last 12 months. So should we be buying Intel, And really, when we look at Intel, kind of think, hey, the next 6 to 12 months, they're probably not going to do that much. The
Yeah.
development of the things that they need to do are so far out. But if I
They're
look at
multi-year
if I
like kind
look
of
at it
developments.
from a 5, 10 year standpoint, I don't think Intel's going out of business, and I don't think the U.S. will even let Intel go out of
Mm-mm.
business.
They'll bail them.
Yeah, because they're one of the few and far between,
American.
U.S. Manufacturers eventually of chips and what have
Yeah,
you.
they have some fabs, but
Hmm.
now they're expanding their
Yeah,
foundries essentially, and
yeah.
so US sees that as a very strategic,
Right. So
important.
that's an example of a story that would work. We'd say, okay, from a long-term standpoint, accumulating some intel, maybe not right now or whatever, maybe someplace over the next 12 months wouldn't hurt. Versus this, we don't see the story. EVs are actually slowing down, so lithium
China
is
is
a
kind
big
of
one. China's stock market is suffering. That doesn't seem like it's going to turn around right away. Again, if that came all the way down to that point, if I was going to be a value player or trader, I might accumulate some there. So it's a great question. It's just kind of you have to look at your own philosophy, your own desires for what's happening, because that actually dominates over whether this is a good time to buy something,
yeah.
right? I mean, that's more important. All right, good question.
So I'm going to buy a car. The car model that I'm looking at, I have the option of 0% APR for 36 months or pay a lump sum. Which one do you recommend?
So zero, so you can have 36 months where they don't charge you anything.
Yeah.
You could take that lump sum and put it in the bank and slowly use it to make the payments for 36 months, and then you net whatever interest you
Yeah,
earned
you have
at
a
the
little.
bank, right?
Yeah.
And there's lots of different things, vehicles you could use at the bank as far as that goes. So obviously, from a financial standpoint, there's no doubt that taking the zero APR is better
Yeah.
than. However, one thing I've noticed in my time frame in this business is that there are more important things than the pure financial calculation to a lot of people, not to everybody.
Yeah. It's how much complexity you want to add to your life and how much time do you want to allocate for that complexity?
Yeah, I have clients that would turn this down because they have no debt. They don't like debt. They don't want to make payments. They want a simple lifestyle. They've already saved up the money. They just want to buy this car and not think about it. And they don't want the risk. And there is a risk, that something happens with that money that was outside and now your car gets repossessed or, very low probability. But nonetheless, that risk is there, at least mentally for
Hmm.
some people. So I do think you have to kind of look at what makes you comfortable. Some people, the comfort is the financial part. They really want to maximize each little piece and set that money over there, and that's their fun. But I have a lot of clients that wouldn't find that fun. So I would say, the answer depends on who you are. Financially, it makes sense to do the, loan
Yeah.
with zero interest rate. That's pretty good. But again, maybe it's not worth it to you.
And one thing is, if you're going into kind of like this negotiation, you may want to lead that you don't lead that you're paying have the option of paying cash. Usually, when you pay in cash, you have to pay a higher price.
Yeah, I have a good friend that's in the auto business, has been selling cars for a long time, and the dealerships make money on the loan, right? So
Hmm.
if you go in there and say you're going to take a loan, or at least they assume you're going to take a loan, the price that you get will be including that loan, right? And so it might be a little bit lower than if you went and say I'm paying cash, because now the dealership isn't making anything off that loan, and so leave it open, because first of all, you need to see all the offers anyway,
Yeah.
and then decide at the end if you want to, you're going to pay cash. And so you should see what they're offering in the loan side, see if it's something you want to do. But I wouldn't go in personally and just say I'm going to pay cash. Say, I'm looking at both options. You don't need to lie or anything, but you might get a better price on
Hmm.
the loan, car with a loan, because they're making money on the loan too. So yeah, just something to think about. All right, that's a good question. What's our next one?
Is it normal to have anxiety about retiring, even though my plan says I have a really high success rate, and it says I can go for it?
Yeah, I don't think I think a plan helps.
Hmm.
It certainly would help me. But life is not a straight line, and so there's always this concern. Hey, I'm about to walk out of a job
Hmm.
and a paycheck, and I'm going to live off of these other sources. Maybe I have rental incomes, Social Security might be coming, I might have a pension, and then whatever assets I've accumulated. Excuse me.
Yeah, especially since you've been working for 30, 40 years. Basically, you have this life that you've kind of made into a routine, and now you're heading into retirement, which is kind of a big unknown to you. You haven't done retirement before. There's no, and so you're heading into this unknown period. There's anxiety with the unknown.
Yeah, so it's just the way it is, right? I will say, in the end, I have heard so many clients say that they're really enjoying their retirement.
Hmm.
Uh, and that the number one comment again and again and again is, I wish I would have done it sooner. And so, that's what's on the other side of that anxiety for almost everybody.
Yeah, once you get there and you start to kind of build that retirement life, because you're shifting your phase of life essentially. Every day before you were going to your job, or on the weekdays you're going to your job working. Now you have kind of control over your rest of your day, what you want to do, and it's a different life.
Yeah, I will say, I would never ever retire without running a financial plan and a Monte Carlo simulation and stress testing it and taking a look at what happened in 2008. If I happen to be retiring right before everything falls apart, how would my assets handle that? How do I bulletproof my retirement as much as I can? How do I plan for the income sources? Where do I take the income from to maximize my overall wealth throughout my retirement? How do I handle the Roth conversions possibilities? How do I lower my taxes? I want that plan. Too many people walk out of their job with none of that.
Hmm.
That is crazy. That would increase my anxiety through the roof. Even if I ended up getting to the other side where I was quite happy, I will say, I'm still going to be anxious, and all of my clients, even though they have all of those plans in place, are still anxious. But the level of anxiety, I think, would be a lot less knowing that.
Yeah, a lot of people have a build up of anxiety when they're going to an unknown event or something they haven't experienced before, and I think that's a natural progression of just being a person in general.
Yeah.
And so it's totally normal to have anxiety about retirement, but you shouldn't sacrifice your length of your retirement because of the anxiety.
Yeah, yeah, and test the retirement out, at least financially. Health is another issue that can come up, those type of things. But financially, you can stress test your retirement, and really, really well, and
Hmm.
get to a spot where you feel a little bit more comfortable. But yeah, no, it's a good question. We've dealt with so many retirements over the years, and so it's interesting to watch that process. We specialize in retirement planning, so this is the thing that we get to see a lot of before and after scenarios. And you just keep in mind, have a good plan, understand how great everybody seems to feel about their retirement eventually, and you'll get there too. Yeah. Okay. Have time for maybe one more?
Is it? Um, what's a callable CD or bond, and would you invest in them?
So callable CD or bond, a certificate of deposit is where you give bank money and they'll hold it for a certain
Hmm.
period of time, 3 months, 3 years, whatever, and then you get your money back and you made interest along the ways. Callable means that let's say it's a 3-year CD, they could call that back at any time.
Yeah, so essentially they'll say, "Hey, we want to call this bond or CD. We're going to pay you and pay you the interest that you've been due for the amount of time you've had it, but you're basically just get your money and then the bond it will contract ends."
Yeah, you get your money back, which is fine. There's no real risk here. You usually do get a slightly higher interest rate
Yeah,
on a callable bond or CD than you do on one that's not callable. But the problem is that the only way they're going to call that if rates are way down.
yeah. So you end up with a interest rate risk essentially
Yeah.
because when you get that money back, you can't get a new CD or bond at the same interest rate that you previously had.
Yeah. So, for example, let's say you have a $100,000 CD, 3 years, right? 5%. You're going along, and all of a sudden rates come way down, and new bonds are at 2.5. Let's say half of the five. They call it. Good, you made your 5% as long as they had it.
Yeah.
That's good because the other, everybody else was making 4.5 back then. You got five, but now you got your 100,000 back, and now you're investing it for the rest of that 3-year term at maybe 2.5
Yeah.
because that's where the market is. So that's the problem with callable. It's only going to get called when the rates are lower, and then you could have kept that money in there at 4.5% instead of 5 for the whole time and not had a callable one. So if that makes sense. So I think it's the advantage to the bank, right? I mean,
Yeah. Essentially, the bank has the advantage because if interest rates go up, they're just going to let it be because they're happy to have paying lower interest rates.
right.
But it's only when they fall that they'll make this callable. So you have to think: is this interest rate differential? Am I getting a high enough extra interest rate to, pay for the risk that I'm taking on that it could be called?
Yeah, that's a great point because I mean, let's say it's 4.5 versus 5, and it's callable. I don't know if that's enough interest rate differential to make me want to take 5 over 4.5. Let's say it's 9.
Yeah.
It's not going to happen, but there is a number that you would say, yeah, I'll take that risk. And so, just from what I've seen in this callable arena, it's not that different. It's not that far off.
Yeah, it's slightly enough to entice people,
Right.
but it's not. The bank is always there to make money.
Yeah.
They're for profit, so
Yeah.
they're not going to, put these wildly high rates.
No, they're better at calculating this than the average consumer. So, again, advantage bank. So, just stick with the regular ones. I think you're going to be fine as far as that goes. And, I still think a ladder works, so you have some CDs coming due at different times. And that way you don't have to guess which way interest rates are going. And you still have some pieces out there. If the rates go up, you're putting those new ones that are coming due into higher rates. If they go down, I have to go to lower. But you still may have some other ones in your ladder that are going out longer that are still at a higher rate. Rates are going to start coming down here. It looks like, so
But we've
you
already
definitely.
noticed that on CDs that
Yep.
the rates have come down. You're getting less.
What would you say it's come down from what to what now? Just on
I remember I was able to get like a 6 month at 5.1, and
5.1.
and now it's down to like 4.7, 4.8.
Okay, yeah.
So
And that trend should continue as they lower rates here. The market is expecting one, or was maybe not today, prior to today's jobs report. The market was just expecting a 1% decrease in the Fed funds rate for this year. I still think that's a little aggressive, but nonetheless, I wouldn't be surprised at all to see a 0.5% rate decrease, and that'll generally translate right into T-bills, right into CDs, and those type of things. So, yeah, that's okay. All right, good. Well, that's our show for today. I want to thank everybody so much for coming. Again, we won't have a show next week. We'll be back in 2 weeks. But send in your questions. Give us some time to take a look at them. Like we've had in some of these, we can make a charts and do some things for you. Basically, we will, ask Tom at talkmoneywithtom.com is a place to send them. And then go ahead and check out the channel, subscribe to the channel, hit like buttons and the bell button to get notified. All that stuff helps out the channel, which is great. And then of course, if you want to, you can just meet with Ethan and I. We have 30-minute times available for free to do a consultation with you. You go to book appointment button and pick out a time that works for you, and we'll meet with you. So look forward to, again, seeing you in a couple more weeks. I will be doing the daily videos next week, Monday through Thursday, so we'll see you then too. But all right, thank you very much for coming and enjoy your weekend.